Hi, I am Christy Preston with Zona Capital. This is our presentation that we gave the other day to a group of real estate professionals, but it was too loud to record, so I wanted to do a little video and go over the slides and give you a little bit of rundown of what we talked about. First question is, what is a syndication? A syndication, in simple terms, is when you combine people's resources, knowledge, skills, and you go take down large properties. It's a way to obviously buy large assets that you couldn't buy on your own with people's either knowledge and resources or financially with their capital. How do syndications work? Syndication teams have basically two types of partners. You've got LP is what we call them. They're limited partners. It's completely passive. Those are your people that are investing in a deal and bringing capital to purchase that property. Then there's the GP team. The GP team does all the work. So the LPs don't have to. They find the deals, they source the deals, they manage the property management company, make sure that the rehabs are getting done. They build the whole CapEx budget, and just make sure that the whole deal is going to be profitable for the investors. They also work on raising that capital and putting those investors in deals so that they can make passive money. GP team, completely active role, working really hard for investors and trying to protect their money. There are two types of investors. There's an accredited investor and a non-accredited investor. Accredited investors, as you'll see here on the slide, are individuals that have 200 plus annually in income, or 300,000 if you're married, or a net worth of at least $1 million. Non-accredited investors are typically sophisticated investors. They know about investing, but they don't meet that criteria that an accredited investor meets. In order to invest in a deal as a non-accredited investor, you have to have a relationship with someone on the GP team. So you can't just invest in some random person that you've never met's deal. You have to have an actual relationship with them. And that's just to protect consumers. The SEC regulates it. They don't want people that don't really know what they're doing to just invest in a deal. They want you to have prior relationship and you're not soliciting to the public and just taking anyone for an investment. So this is an example of purchasing a single family property. I know as real estate professionals, we all know what it takes to purchase a rental property. A lot of us are agents, we own our own properties, but a lot of times there's headaches with them. You have to manage the property, you have to fix leaky toilets. Nowadays, it's really hard to buy a cash flowing rental property with interest rates being where they are. So this is an example of if you had bought $400,000 house, put 20% down, you're gonna have closing costs, probably gonna have to fix it up a little bit. Cash investment in this specific example was $100,000. You're gonna rent it for $2,000 a month, minus all your mortgage, taxes and insurance, maintenance. You're basically losing money, $1,500 a year, and that's if everything goes right and nothing huge breaks. If you assume appreciation on that, you will obviously eventually make some money. In our current market, we've seen things go down a little bit. They're picking back up. So I just conservatively did, a 3% appreciation over 5 years with closing costs of selling. As agents, we don't have to pay the full commission, but we do have to pay, a buyer's agent. And then potentially concessions, not sure what that looks like in 5 years. But let's just assume that your closing costs with commissions was only 5%. Your net return on that is around $40,000. So not a great return. 6.58% would be your average annual return on that specific deal. Now I wanted to show you what a syndication deal looks like. In syndication, you add value to a property and you are able to force appreciation. So in multifamily specifically, you are purchasing and selling on cap rates. And the higher that you can push the net operating income, the more you can sell the property for. That's plain and simple. There's no comping. There's no, what did the property down the street sell for? It's as much income as you can get that property to make. That divided by the market cap rate is going to be what you can sell it for. So this is an actual deal that we closed on in June. Purchase price was $12.425 million. You can see where we were getting our debt. We raised about a little more than $5.8 million. And we had a $1.3 million CapEx budget to fix this property up. Now, in syndication, like I said, there's forced appreciation. So what we're going to do, there's a few things. You find a property that's either poorly managed and you can lower expenses by fixing the management of the expenses, or you find a property where rents are low, you can raise them. Also, you find properties that are classic units, meaning, they haven't been remodeled. And so you can go in and remodel them, raise the rents. Again, we're forcing that net operating income up so that we can exit in about 5 years and sell it for much more. On this specific deal, we were planning on exiting at 6.5% cap rate. That was a conservative exit for us. On that deal, I won't, you have cash flow that you get. The average cash flow of the deal was 9% a year. And then when you sold it, if you put in $100,000, you would get $62,000 in returns from the sell. So you're basically more than doubling your money in 5 years. It's completely passive. You're doing nothing other than receiving a check quarterly. So you get that mailbox money by just, investing in a deal and letting us do our thing. There's no management on your part at all. On this specific deal, a little bit, we do think it was attainable to get a 6% cap, but we want to be conservative for our investors. So if we do achieve that 6 cap exit, you're going to 2.26 times your money in 5 years. Now going back to that previous example where we had the single family property versus this current multifamily property that we just purchased, your average rate of return annually is going to be 21% on that multifamily deal versus the 6.58. And again, you're going to double your money in 5 years. You're going to get, which I didn't explain, a preferred return, which means the limited investors receive 8% on their money quarterly before the general partners receive a penny. So the waterfall of how cash flow is distributed is our limited partner investors, they get all of it until we hit that 8% for them annually. We don't take anything. We pass it all on to our investors. If you find a deal where that's not a thing, I would run from it. For multifamily, there is huge tax benefits. Obviously consult your tax professional because everyone's situations are different. But as real estate professionals, we do have that real estate professional status where we can potentially offset our active income with passive income. Whereas if you're not a real estate professional, you only get to offset passive income with passive losses. In multifamily, we do a cost segregation study in the first year. And that gives you, if you're familiar with taxes, you get a K1 and you're going to have a huge loss on that first year to offset your income with the cost seg and the bonus depreciation. If you put in $100,000, you're going to get 50 to 70% of that as a loss. So $50,000 loss up to $70,000 loss to offset your income. And that's just because we're depreciating, we're writing off a bunch of stuff in the first year. It's not actually losing money, it's just tax benefit. We here are Zona Capital Group. We're a private equity firm that helps people invest their capital in multifamily through syndication. We work with teams of syndicators to bring you investment opportunities. We would love to let you know about our future deals if you're interested. If you are, head on over to our website, click on the link. There's a form where you can kind of give us a little bit of an idea of what you're looking to place, what kind of capital you're looking to place. And that just helps us in future deals know what we can put you in and what deals we should bring to you. If you have any questions, comments, please reach out to us. Here's our phone number, website, and email. Thank you so much for watching. And again, reach out if you have any questions. We would love to help you out.